Now the chapter 4 will be the consolidation. Again, we're talking about only at the date of the purchase. Here we're talking about only on the date of the purchase. What's happened on the date of the purchase? Nothing more, nothing less. Right? Time hasn't passed yet. There's no operations, nothing. We just purely the date of acquisition. So let's see what's going to happen in this case when we're not purchasing 100%. So far we saw what's going to happen if we purchase 100%. Let's see now we're not purchasing 100%. When the parent acquire less than 100% of the shares, then the parent own assets and liability and parent shares of subsidiary asset and liability will be measured at the carrying value and the fair value on the consolidated balance sheet. Let's see the example here now. We're going to have this balance sheet. We're going to have cash. So let's see. Let me get this one and flip it to the Excel spreadsheet.
Okay.
And I'm going to open a new Excel spreadsheet. I'm going to label it that's for chapter 4. And we're going to see how exactly this one works. So far, this is just information. There's nothing scary here so far, as you can see. We just give you the parent and subsidiary all together on one document. That's all that we have in here. Nothing more, nothing less. And as you can see, now there's differences. So we have the carrying amount and we have the fair value amount. Fair value amount, where's the difference? The difference first is the inventory is up $2,000, fair value versus carrying value. Plant is up with $9,000. Patent goes down with $1,000. Then the current liability, no changes, and the long-term debt increasing with $3,000. Those are the only three. So we have $3,000 increase in liability and $10,000 increase in the assets. So the net increase is only $7,000. Make sense? $10,000 in assets,
10,000.
$3,000 in liability, offset
Yeah.
$7,000. Right?
Mm-hmm.
So now let's see. The shares the shares non-acquired by the parents means that they're owned by somebody else. If the parent only buy certain percentage of the shares, that means the rest is owned by somebody else. That's called non-controlling interest, because we cannot control that one. So those are related to the non-controlling shareholders, and it has to appear on our balance sheet as a non-controlling interest. So the question is, how should the portion of the subsidiary net assets which are not acquired will be valued on the consolidated statement? And how that non-controlling interest should be measured and how should be presented, both of them. So let's go one after another in order to answer this question. There are 4 theories here. One is the proportional consolidation method. Second is the parent company method. Third one is the identifiable net assets method and fair value enterprise method. Don't get scared. So far, don't get scared. There are 4 methods, but there's simplicity here. The proportional consolidation method used to be called proprietary theory. So that means if used to be called, that means it's not called anymore because it doesn't exist. that's the thing. Now, identifiable net assets method used to be called parent company extension theory and sometimes referred as the partial goodwill method. The fair value enterprise method used to be called the entity theory method and sometimes referred to the full goodwill method. So we have partial goodwill method and full goodwill method. So let's see what we're going to do. Each method has been or currently required by the general accepting accounting principle. That means not all the methods are required. So let's see which one is required, which one is not. Proportional consolidation method, current general accepting account for consolidating certain type of joint arrangements, was an option under intention prior to 2013. So this method was option prior to when consolidating joint ventures. So that means now it doesn't exist. Parent company was the general accepting for consolidating subsidiaries prior to January 1st, 2011. So that means now it's gone. So do we have to spend time on those? Probably not. Then identifiable net assets method. That's acceptable option for consolidation of subsidiary after January 1st, and fair value enterprise method is the acceptable option for consolidating subsidiary after January 1st. So we're going to spend only on those two methods. So let's see what's the difference. On the proportional method and the proportional company method, we're not going to talk about this because those are not accepted anymore. So let's skip those one. Let's go to identifiable net assets method. On the identifiable net assets, as you remember, that was also called partial goodwill method. So we're going to show some goodwill on that one. Where the fair value enterprise method was called also full goodwill method. That means there will be no goodwill on the non-controlling interest. Now, let's start one after another. Consolidation method. Now, we will illustrate this preparation of the consolidated financial under this method using the following example. Now, we will examine PNC, the one that we have on the previous slides. Both companies have June 30th fiscal year. On June 30th, year one, subsidiary S had 10,000 shares outstanding. And parent purchased 8,000 of those shares at the total cost 72. So in this case, will be simple. Parent is going to invest. Is going to show investment on their books, and they're going to pay cash $72,000. That's about it. There's nothing scary here. Now, proportional consolidation method. View the consolidated entity from the standpoint of the shareholders and the parent company. Therefore, do not reflect anything. That's for the proportional consolidated method. Consolidated balance sheet on the date of the acquisition reflect only the parent shares of the assets and liability of subsidiary based on their fair value and result goodwill from the combination. Parent company method, similar to proportional method, focuses on the parent company but gives some recognition of the non-controlling interest. This one will be not however, this reporting certain joint ventures. So this method is not used in practice. The first one, proportional, for to consolidate a parent and the subsidiary. So this one for consolidation purpose is not used. However, it's used under certain type of joint arrangement. So when we go to chapter 9, we're going to talk a little bit about this, but just a little bit. It's not going to be tested. Anyway, parent company, that's not illustrated, so that's why I'm not spending time on the proportional and the parent. Now let's go with the fair value enterprise method, which is a net identifiable assets method. So let's go with the first one. This one views the consolidated entity as having two distinct groups of shareholders. the controlling and non-controlling. Now, the fair value enterprise method, equal attention is on the controlling, on the non-controlling interest. So the investor here typically pays a premium over the trading price of the company shares when we're getting the control. Now, the discounted cash flow analysis could be used to eliminate the fair value of the subsidiary if we want to go that one. Let's go with the example here. Example 1. The fair value of the non-controller is evidenced by the market trace. So we're chasing here what's the fair market value of the non-controlling interest, because fair value enterprise gives the equal attention to the controlling and non-controlling interest. So let's see in this case. They purchase 80% of the subsidiary, or only 8,000 shares, for $72,000, paying $9 per share. Now, the current shares are trading 775. I'm going to copy this, and I'm going to move to the Excel spreadsheet. I'm going to move this information to the spreadsheet, to the Excel spreadsheet, and later on we're going to come back to the Excel spreadsheet and we're going to talk about this. And I'm going to come back to the slides. So, what's going to happen at the acquisition date? First, we have to see how much is we paid. We paid $72,000, $9 for 8,000 shares, but that's not the entire value of the company, because they still have 2,000 shares which are owned by the other investors. So we have to come up with the fair value of those 2,000 shares, which will present the net fair value of the non-controlling interest. And since we know that the shares are currently traded by 775, that will give us the non-controlling interest of the 15,500. So at the acquisition date, the fair value of the company is 87,500. Make sense?
Yeah.
So far, nothing scared,
Okay.
right? So far, nothing scared. So let's flip this one on the Excel spreadsheet and let's work on this. And we're going to go slowly, we're going to go there. Don't worry. Try to make it as simple as possible so you can understand it. The whole point is you to understand the whole thing. Now, the sad story is once you understand it, the practical application will be pretty much zero unless you're doing the consolidation. That's the sad story. So it's kind of knowledge, but knowledge that you may never need. Anyhow, let's pretend that you're going to need it. So I'm going to explain to you that you're going to need it from that assumption. So fair value, again, we purchase 8,000. So at the date of the acquisition, we're going to have the fair value at the acquisition date. We're talking about acquisition date only. So the fair value, let me see if I can copy this one, or rather than, yes, I should be able to copy it. This is the fair value of controlling interest. The next thing is the fair value of the non-controlling interest. And the third one is the fair value of the acquisition date. Which represents fair value at the acquisition date. That's what we're chasing. We're chasing the fair value at the acquisition date. How much is that value? become too many of those. Let's get rid of some of them. Okay, so we have non-controlling interest will be $72,000. Then we're going to have, I'm doing this because I'm going to use it later. That's why I want to do it here so you can see the whole idea. Then we're going to have the non-controlling interest. Now the non-controlling interest, as you can see, we're using the fair market value or the trading price of those 2,000. That's how we come up with the $15,500, and that's going to give us the total value of the company at this point, which is exactly $87,500. By calculating, again, we're calculating the non-controlling interest based on the current market price of the shares which are sitting outstanding. So once we do that, now we can start working on the this sheet, which is going to give us the, I'm going to copy it and I'm going to come here on the Excel spreadsheet. So that's why I'm going to leave you for now for the Excel spreadsheet. And then we're going to calculate this one. Calculation of the acquisition differential at the time when we purchase the company. Again, this is only on the date of the acquisition. Nothing happened yet. The company, nothing, there's no transactions, nothing. This is only on the date of the acquisition. So, what we purchasing of this company? That will be the question.
70.
So, in order to do that, to see what we're purchasing, we have to go here to the company, right? So what we buy? We buy 100,000 assets on the book value, and we're buying 30,000 liability. Make sense? So we buy 100,000 assets, and we have 30,000 liability. That's going to give us total of 70,000. That's not what I wanted, but let's go back to 100,000, and that's going to give us this one plus that one.
Yeah.
Right? So we got that 70,000. Then what we're going to do? We're going to chase the fair value minus the carrying amount or the book value of all the assets that we have. So basically here we have this one minus that one. We have increase, and that will be increase in the, first we're going to have increase in the inventory with $2,000. Can you guys see it? Then we're going to have increase in the plant with the $9,000. Then we're going to have decrease in the patent with $1,000. Then there's nothing here. And this one will be the last one. That will be 22, 1, 2, 3, and 25. That will be increase in the liability with $3,000. Once we have all those elements, we're going to start adding them here. First, we're going to have Inventory went up with 2,000. Plant with 9,000. Patent went down with 1,000. Liability total change here. This total change is 10,000. Here we have increase in liability. Let's change the formula. That will be this one minus that one. Increase in liability with 3,000. Total change will be, net change will be 7,000. Make sense? So the same thing here. 10,000 here. We're going to have increase in long-term debt with 3,000. So the net change is 7,000. Now, once we pay the 80%, we're paying only $72,000. Why are we paying $72,000? Once we pay the $72,000,
because it's
80% of those assets, so that will be the total net assets, is $70,000. But we own only 80% of those. That's give us 56,000. Make sense? Where
this
the
is
other
the value for the 80%, right?
for the 80%, yes. Out of those 70, only 80% are ours. So because we purchase 80%, that's 56,000. The other 14 belongs to the non-controlling interest, which is 20%. So for that reason, we're paying $72,000, which gives us acquisition differential of 16,000. Now those 16,000, the total acquisition differential is 7,000. But since we own only 80% of the company, only 5,600 is belonging to us. So in this case, we're going to have a goodwill on our balance of $10,400. For the non-controlling interest, we already established the non-controlling interest is 15,500. Now from the net assets, 14,000 belonging to the non-controlling interest. So that gives us on the non-controlling interest, there's acquisition differential fee 1,500, which is allocated 7,000 or 1,400, 20% of 7,000 is related to the non-controlling interest, which give us non-controlling interest only of 100% is allocated to the goodwill. So the total is $10,500. So if we have to do this based on the 100%, fair value of the acquisition was 87. Correct? Book value of the assets are 70,000. That gives us differential 17,500. We are allocating 7,000. So the goodwill tend to be 10,500. Now, how this goodwill going to be allocated? 10,400 will be allocated to the parent, and 100 is going to be allocated to the non-controlling interest. We can easily go in that direction, get the total, and work with but we still need the percentages to come up with the goodwill on the non-controlling and goodwill with the parent. We still have to do separate allocation of those ones. Because as you can see, the 10,500, it's not $100, it's not 20% of the 10,500. Right? That will be the tricky part here. That's why we need to do the separate calculation for the parent and separate calculation for the subsidiary when we know exactly the market value of the non-controlling shares. So let's go back to the slides and see what's the next on the slides there. So the next example is fair value now is implied. What that means? We don't have access to the fair value of the remaining shares.
Mm,
Make sense? In the first case, you see that we know how much is the fair value of the shares. We know that the other 2,000 shares are traded at $7.75. In the second case here, we don't. We don't have that information. Now the question is, what we're going to do in that case? Well, in that case, it will be very simple. And I'll tell you why it's so simple. Because we're going to imply that amount. How are we going to imply that amount? Well, show you in a second. Just a second. Let's flip to the Excel spreadsheet. Can you guys see my Excel sheet?
yeah.
So in this case, we know how much is the fair value. In this case, we don't. So what we know, when we purchase 8,000 shares, we pay $72,000. How much is this? We have no idea. But the other thing that we know is those 72,000 shares, they represent 80% of the total common shares, correct? We already know. We acquire 80%.
Mm-hmm.
So non-controlling is 20%, right? And once we have those two, the total should be equal to 100, correct?
Mm-hmm.
So now, if we don't know, if for the 80% I'm paying 72, how much would I have to pay if I purchase 100%? Do you understand this?
How much?
So if if I purchase only 80% of the shares, I'm paying $72,000.
Mm-hmm.
How much would I have to pay if I purchase 100% of those shares?
Mm-hmm.
Do you understand
Mm-hmm.
what the question is? So
90.
so
90.
so question is, I have X, I have amount that I don't know. Once I pay 80% of that amount, I'm paying $72,000.
Mm-hmm.
The question is, how much is X?
This is the 100% is 90.
Right?
Mm.
That's the question. So how am I going to get it? X will be equal to what? If X times 80% give you 72, how can I find X? What do I have to do? I have to flip 80% on the other side, correct?
Mm-hmm.
So it's going to be 72,000 divided by
10.
divided by 80%.
8. Yeah.
80%. And that's going to give me, how much is going to be that?
Mm-hmm.
That's going to be 72 divided by 80%.
Mm-hmm.
So 90,000 will be the total amount. Make sense?
Yeah.
So this amount here should be 90,000. So then can I get my non-controlling?
Yep.
How much will be that?
18.
19 minus
That's a 19.
minus 72. It's going to be $18,000. That's how I'm implying the interest, the non-controlling interest that will be implied. Why? Because I don't know how much is the
Value.
fair market value of those 2,000 shares. So once I have this, what I have to do is I have to do the same calculation like before. So let's see, I'm going to copy that calculation. I'm going to flip it here, and you're going to have it here on the Excel spreadsheet. And let's follow this calculation now. So again, for the 80% of the company, I'm paying 72,000. Since I'm using the implied amount, the question is, how much would I have to pay if I purchase 100%? So that will be 90,000.
Mm-hmm.
So the 90,000 now is implied value of the company that I'm purchasing. 100, I have book value is 100,000 assets and 30,000 liability. I'm putting those one. 100,000, 30,000, that's 70,000. That's going to give me $20,000 acquisition differential. How am I going to allocate that acquisition differential? 10,000 is going to go to the assets. 3,000 is going to go to the liability. In total, net will be 7,000. Make sense? So the balance of the goodwill in this case will be 13,000. So you can see now we have a difference. Here the balance of the goodwill was 10,000. Here the balance is 13,000. Why is that? Because obviously here the fair value of the enterprise is lower. It's 87,500. Here is higher because we just implying that amount. Here is 90,000. So for that reason, we have that difference of $2,500, which exactly is adding to the $13,000. So how are we going to get the non-controlling interest? So from the implied amount, since we don't owe 20%, the non-controlling interest in this case will be $18,000. Where this is our calculation, 18,000, where in the first case the non-controlling was 15,500. And that's how we deal with this situation. Now the next thing that we have to do is start preparing the consolidation by using the direct approach. How are we going to do that? Well, very simple. In the direct approach compared to the worksheet approach is relatively simple. If you remember, the worksheet approach is the one that we're going with the debit and credit. In the direct approach, we're just following the assets and cash and everything. So let me change this one. So what we're going to do in the direct approach, we're going to start following our sheets here. Which one is this one? Let me copy this, flip it right here on the bottom so you can see one and the other. So what we're going to have? I have my cash, $72,000. Sorry, $100,000. Their assets are $12,000. But I pay $72,000 for the shares. Remember, we're paying $72,000 for the shares. So we have to eliminate those from our assets. So our assets will be $40,000. So 100 plus 12 minus 72, 40,000. Accounts receivables. My accounts receivables from their accounts receivables going to give me 97. Inventory. My inventory plus the inventory plus the increase in the inventory is going to give me 152. Plant, my plant plus their plant plus the increase in their plant, 9,000, is going to give me total plant. Patent, I don't have patent. They have patent. But that patent went down with $1,000. That would be $10,000. And then I'm going to have a goodwill, which we're going to get directly from the balance of the goodwill, $30,000. And I get my total assets. Questions?
No, I don't think so.
No? Okay. This one is straightforward. There's nothing hidden here, as you can see. Liability, exactly the same thing. Liability and equity. So now let's go with the liability and equity. Gonna post it here. So the liability. My liability plus their liability gonna give me the total liability. Long-term debt. My long-term debt plus their long-term debt plus the decrease, no, actually here increase with $3,000 in the long-term debt is gonna give me total debt. And the total liability. Now, since I combine, so watch this, since I combine those two numbers, 100 minus 30, how much is it? 70, right? I already put those 70 on the consolidated, so I don't have to do this anymore. Make sense? So on the consolidated balance sheet is going to stay only my common shares and my retained earnings. And the last thing that left is the non-controlling interest, which we're calculating is $18,000. And once we add that non-controlling interest, that's going to balance our assets and the liability section. The only thing is, don't forget the non-controlling interest. And we are done with this. So this one was the fair value enterprise method. So now, sometimes is inappropriate. It is appropriate to measure non-controlling using the price per share paid by the parent. The implied value assumes that the parent acquisition cost can be extrapolated linearly. So basically, when we're doing the implied method, we automatically assign the dollar amount for the non-controlling interest. Why? Because we don't have the current market value of the non-controlling interest. Now let's see what's the identifiable net asset method. So to address the concern about the goodwill valuation, we using the net identifiable asset method. So what is the interesting here? Then non-controlling interest will be calculated different way. So we're going to get the carrying value of the assets. We're going to get the carrying value of the liabilities. Then we're going to see how much is the excess over the fair value of the assets and liability. That's 7,000. 10 minus 3. And we're going to get the fair value of the net identifiable assets. For that amount, we're going to apply the non-controlling interest percentage. And we're going to get 15,400. That's the only difference between the fair value enterprise method and the identifiable net assets method. So under the identifiable net assets, we calculating non-controlling interest by as a percentage of the fair value of the identifiable net assets. That's it. That's how simple is this. We don't have to do those crazy calculations, and we have two scenarios with again, we're chasing only the non-controlling interest. So let's flip this one on the Excel spreadsheet as well, so you can have it everything there. If you need to go back to the Excel spreadsheet, and you're going to have all those calculations for you available. Let me see if I copy it this way. Is it going to change anything on the presentation on the Excel spreadsheet? No, it doesn't change anything. So let's leave it the way it is. Okay. So now, negative goodwill. The question that you asked me before. Remember those? You asked me what's going to happen if we have a negative will. Well, if we have a negative goodwill, that means we're paying a bargain price. That means we're buying something below the fair market value.
Okay.
So in that case, we're going to have this bargain price. That requires that the negative will be reduced to 0 by first reducing all the goodwill in the subsidiary books, and then recognizing the remaining new goodwill as a gain. Since the negative goodwill is very rare, the parent should check the valuation for the identifiable net assets. So let's see this illustration here, how it's going to be. I'm going to copy this illustration. And we're going to see it on the Excel spreadsheet, how exactly it's going to work. That's not the one that I wanted. Okay, I have this one, acquisition, and then let's get the next slide, which is the calculation. So let's see this one. I'm gonna flip to Excel spreadsheet again. So in this case, we have now we back to 100%. No more with messing with the non-controlling interest and anything like that. So on June 1st, this company purchased of 100% for $72,000 cash. The carrying amount is identifiable as 70,000. Acquisition differential is 2,000 on that date. 7,000 of the acquisition differential is allocated to the net assets, leaving of 5,000 negative goodwill. Now the calculation will be shown, not on the next slide, it's going to be shown right here on the Excel spreadsheet. And the calculation is going to be, let me move this one here, and I'm going to paste it here. Let me do some adjustments here, and then I can. So this is our calculation, and the slides should be here somewhere. Let's move it down so we can see on one screen the slides and everything that we need. So what's happening in this case? We're paying $72,000. Our assets and liability are 70,000. We have the acquisition differential only 2,000. Make sense? Of that acquisition differential, we are allocating 10,000 to the assets and 3,000 to the liability, which give us $7,000. So 2,000 minus 7,000 is going to give us 5,000 negative goodwill. That means that the fair market value of the old assets is 77,000. Make sense? And we pay only 72.
Uh-huh.
Does that make sense?
Yeah.
So for the 72,000 something, we pay only 72. So basically we pay $5,000 less, which is transferred to the negative goodwill. That's how you should explain yourself that one. So now let's see what's going to happen. If that happen, negative acquisition. So now is the question is the negative acquisition differential same as a goodwill? Negative goodwill? No, it's not. So for example, let's go back to the Excel spreadsheet. What I'm trying to do, I'm trying to share my Excel spreadsheet. So is it possible here to have a negative acquisition differential and positive goodwill? That will be the question. Is that possible? So in this case, as I have, as you can see, I have a negative goodwill. Why do I have a negative goodwill? Because here I'm paying 72 minus 70. Probably that will be a mistake now. Yes, 72,000 minus 70. It's going to give me $2,000, right? And once I deduct those 7,000, it's going to be, this one will be equal to 2,000 minus 7,000. That's probably going to be a mistake, yes, because this should be 70, 1, 2, 3. So that's going to give me that $5,000 negative goodwill, right? But is it possible to have a negative acquisition differential and positive goodwill? That will be the question here. Well, yeah, definitely. Well, it's possible if the carrying value of the assets is, let's say, is what will be that? Carrying value of the assets is more. That will be 75,000. Let's pretend that 75,000 is the carrying value of the assets. Then I'm going to have a negative acquisition differential. Can I have a positive goodwill? Yes, if the long-term debt increasing, not with minus 3, but let's say with minus 15,000 or 15,000, then my number here is going to be equal to 10,000 plus minus 15,000. So if that's 10,000 here, minus 15,000, so then I'm going to have a deduction if in my fair market value, and I can end up again with the positive goodwill, as you can see here. So a negative acquisition differential, it doesn't mean you can have a negative goodwill. That's what the slides try to tell you here. So let's go back to the slides and finish those slides at once. So that will be the negative goodwill. Acquisition is not the same thing like a negative goodwill. It's possible you to have a negative acquisition differential and positive goodwill. So what's going to happen if the subsidiary has a goodwill? I'm not going to spend time on this. That's too much. I'm not going to test you on that one. That will be too much. And contingent consideration, again, that's not going to be part of this course. So I'm going to limit myself only to this part. Up to this slides to the negative acquisition goodwill.
Okay.
So you're going to have a question on the assignment. You're going to have a question for the net assets method and the fair value method enterprise. But again, remember whatever we're doing today, it's only at the acquisition date. So focus on those few things. Focus on the calculation of the acquisition differential, which acquisition differential always will be the price that you're paying versus the book value of the assets that you're having. And after that, allocate that acquisition differential to the difference between the fair value and the carrying amount or the book value of the assets of subsidiary. Once you get those two, acquisition differential and in the difference with the fair value, then you're going to allocate that acquisition differential to that amount, and whatever it's left, it's going to be goodwill.
Okay.
Right? So now, if you don't purchase the 100%, check what's the next thing. Can you get the non-controlling interest? Is it given to you? Can you allocate it as a based on the market value of the shares which you're not having, or you have to imply it?
Implied, yeah.
Right? That will be the other. If you have to imply it, then automatically you're moving to the fair value enterprise method. Right? If the question asks you for the net identifiable asset method, then get the assets, book value, add or deduct the difference between the fair value of the identifiable, or the excess. If there's excess on the fair value versus book value, add it. If there's a deduction, deduct it. Get the fair value of the identifiable assets, apply the percentage of the shares that you don't own, and get the non-controlling interest.
Okay.
Okay? Okay, guys. That will be all for me for today.
Okay.
We're staying only on the acquisition date. We're not moving any further. And the acquisition date, the two scenarios, either you purchase the 100% of the shares, either less than 100% of the shares. So if you purchase the 100% of the shares, there will be no controlling interest. So you just do the pure calculation of the acquisition differential, allocate that acquisition differential to the fair value versus book value, whatever left, goodwill, and then do the balance sheet. Only the balance sheet you have to do at the acquisition date by adding the assets and the liability from the other company, plus the change in the fair value, and eliminate the common shares and return of the other company from your from the consolidated balance sheet at the date of the acquisition. If you have less than 100%, then calculate the non-controlling interest, either implied, either the fair value, and then follow the calculation. That I'm going to post you this calculation with this Excel spreadsheet. I'm going to send it as an email to you with the links to the both videos. Okay. So you're going to have both the videos and the Excel spreadsheets from today.
Okay, thank you so much, Professor.
You're welcome, guys. Don't forget on the assignments, once you start doing the assignments come with the Excel spreadsheets.
Yeah.
Right? Follow the Excel spreadsheets. On the Excel spreadsheets, most likely you have to just change the numbers and everything's going to come.
Okay. Yeah. Okay,
Okay,
for
good.
next classes, we have 2 more assignments, right?